Hello, hello. Did I wake everybody up? Hello. Hello, there we go. Okay. I just wanted to make sure we were all still there. Welcome. Thank you for coming. You've heard me say this before, but we know you have a choice. Where you could be on Tuesday night, we appreciate you being here, spending it with us. We're supposed to have about 30, 40, 50 in the room tonight. I believe Mo told me we've got about 160 online. So everybody give a hoop and holler welcome to everybody, the 160 that are online. Every once in a while, Mo will turn that camera around and show some of his faces. So always be smiling. Always be smiling. I'm going to cover a couple of housekeeping issues. If you need to use the restroom, for those of you who haven't been here before. In fact, let me go ahead and start with that. If this is your first time you've ever been here to the DGRA meeting, raise your hand, please. One, oh, come on, Reggie. 2, 3, 4. Okay, 5. Before you leave, I want you to promise me that you're going to give me a chance to shake your hand, okay? Answer any questions that you might have. And I'm going to introduce the team, too, so reach out to any of them. Because as we are so fond of saying, you really don't want to talk to us. I mean, we'll tell you. We'll tell you. But really, who do you want to talk to? All of the people in the room that did not raise their hand. Why is that? Because they're the ones who know us better than we are. They'll be honest with you. They'll tell you about our experience. Won't you, Alex? Will you tell them, Reggie? You'll be honest with them? Okay. Phil, will you do that? Okay. Good deal. Just ruined all of my credibility buildup. Just ruined it all in one fell swoop. Oh, okay. Yeah. We'll have his check ready for him. Again, if you need to use the restroom, I would just ask if you please will go out the back door, just so we don't interrupt our presenter. And the restroom is, when you go out the door, if you're a female, just go right across the hallway. If you're a male, take a left, and you'll find a restroom on the right-hand side. It says men on it. And you will have to have, whether you're female or male, you'll have to have a code, 432 enter. We'll get you in the restroom. And if you forget it and don't want to ask, I wrote it on the backboard. So you can have it there. It also says back there, welcome DGRE partners. It's kind of faded on me. I don't know what's going on with that marker. But anyway, thank you for being here. Those of you who are online, thank you for being here. I know you didn't come to hear me speak, but we got some really good news for you now. I know one of the biggest reason you're here is because you came to hear the guest presenter, and I'll introduce her in just a minute. Before I do that, I'd just like to introduce some of the team members that are here. I'm just going to start on the right-hand side. Ben, would you stand up, please? Ben Mandelstein. Again, those of you that have been here before know who Ben is. Ben is a co-sponsor with us with the DGRE group, and we're going to talk. I'm not going to steal your thunder, but at the end of this, we're going to hand out a big check, okay? And that's because Ben just sold his property down in Waco, the Brazos. So, excellent, excellent. Reggie, would you stand up, please? Reggie Betos. We already passed out a check for Reggie's property, so sorry, Reggie. We already passed out a big check for your property. But Reggie is also a co-sponsor, and about 6 weeks ago, sold 2405 at Park Row. Great success for Reggie and his partner. So, again, thank you for being part of the DGRE team. See if I'm missing anybody here. Anand, yes. I almost didn't even see you, Anand. It's hard to say. Anand Upadhyay. Okay, I got that down. We're going to pass out a big check tonight, too, or we're going to let Anand pass out a big check tonight. And that's because his property is also a co-sponsor. This didn't work out this way. It just happened to be that all three. Anyway, we're going to hand out a big check tonight because his property, which is Southwest. How many of you Southwest partners in here? Okay, there you go. Okay, you've already got a big check, but we're going to do a ceremonial big check tonight. But Anand, thank you again for being part of our group. Great success. I'm going to move right across. John, would you stand up where you are, please? John Blackman is also a co-sponsor. We just haven't found him a property yet. So he's still looking. Not the greatest time in the world to be finding a property, but we're going to do that, John. We're not giving up. Yeah, he's in Austin, and, hey, huge fan. I wouldn't live there in the world, John, but huge fan. Keep Austin weird. Keep Austin weird. I'm all for it. Okay, in the back, leaning up against the wall, Mr. Garrett Stroud. If you haven't met Garrett, please do that. Garrett is part of our investor relations team. So if you have problems with IMS or you're trying to send in money, Garrett's the one that's handling you for all that. So he can help you with that. Julian, if you'll raise your hand. Julian heads our investor relations team, is also writer, underwriter extraordinaire. Be honest with you, we don't have any titles here. It's just what's our company motto? On whatever it takes, right? WIT, whatever it takes. If the toilet needs to be cleaned, Julian will go clean it. If a unit needs to be trashed out, I'll go trash it out. What's that? Okay. I can't tell a lie. I can't tell. Anyway, thank you for being here. And I'm one more who usually does not grace us with his presence, but a member of our Dar Corp team. Dillard, I'm going to ask you to stand up real quick. Dillard Stone is we give him the title of controller, but he will tell you he doesn't control anything. Okay? But Dillard makes sure that if we spend money, it goes in the right place. And if we don't have any money, he doesn't let us spend it. So, thank you, Dillard. Oh, yeah, well, yeah, between he and Brian Johnson, they're responsible for making sure you get your monthly distributions as well as your big checks. So, oh, yeah, that got him a big applause. I can stand up here and slave all day, but the guy who cuts the checks gets the guy who initiates the ACH electronic banking transactions, right? No more paper checks. We don't like that. Anyway, again, thank you for being here. I am going to, we've got kind of a full, can I borrow that clicker, please, Donna? Just real quick look at the agenda. Hey, welcome. Okay, we're going to talk taxes tonight. Now, you don't want to hear about taxes from me, trust me, but we do have a professional in the house, okay? Miss Donna Reuter is not only a CPA, but she is and when I say that, all of our, if you are invested with us, and I'm sure if you're in this room you are, unless you're brand new, then she's the one who does all the tax returns for the properties. Okay? She's the one that makes sure all the K-1 information is correct, right? Very important role for us. So anyway, Donna is willing to come and talk to us tonight about not only what's going on now, and I'm not going to steal her thunder, but maybe what might be coming, things you need to kind of plan for, and all that. When we get through with that, we're going to go ahead and move into Q&A because my gut feeling is you're going to have much more Q&A for Donna than you're going to have for anything that I bring to the table tonight. So we'll stop the meeting at that point, do a Q&A while it's fresh on your mind, and she blows your mind, all this tax information, where you can ask those questions. And then Julian's going to come up and just kind of give you an update on our Frankfurt Station partner loan. And then we're going to save some really exciting announcements for the end. What do they call that? Keeping you in the seats so you stay here to the end of the meeting. I know you want to stay here the whole time anyway. So anyway, without further ado, I'm going to introduce Miss Donna Reuter, again, CPA extraordinaire and does ours. All I would ask, and she may change this now when she comes up here, but I'm going to ask you to, let me say this first. We are not tax advisors, okay? You should always be checking with your own CPA, but I guess what I'm asking is to kind of help. We could be endless tonight with tax questions, so if you'll try to keep them to not general questions, but as to they affect you and your properties that she's in charge of. Now, if she wants to answer any other general questions, I'll leave that up to her, but I'm not going to put that on her. Donna, this is yours, and that's your forward and your presentation's racked and ready to go. Thank you, everyone. Give us just a second. We'll get it. I see the red light. Let me make sure you're not.
Okay, now I'm on. Now I'm on. Okay. So how are you guys doing tonight? As Brian said, I'm Donna Rudder, nutter butter, boat rudder, whatever. I get called all kinds of things. Rudder being not the least of the worst of what I've been called before in my life. But I did put together an agenda for you guys today. I guess a little bit of background. I've been in public accounting pretty much my entire career. A little over 30 years, specializing in taxes. I've worked with the Big Four public accounting for the majority of that career, and with the exception of about an 8-year stint as a partner in a local firm in the Dallas-Fort Worth area, and then about a year and a half ago, ventured off on my own and took over this established practice, and was very happy to be the tax preparer, for Darwin German in this group, and to assist you guys. a lot of my career in Big Four public accounting was in the real estate industry. So I have a lot of, background with that. One thing you may have noticed, I'm a little congested. I've been a little sick with this sinus infection going around. It's not COVID, not the flu. Strictly allergies turned into a little bit of a sinus infection. So I had put together this, great presentation, but I'm kind of not feeling it, and I don't think you are either, because you're not tax professionals trying to get CPE. So I think let's just have a conversation, and let's just talk about taxes and what what the impact is for you on this investment. And some of the things I know that Darwin wanted me to communicate to you is some of the tax planning that we incorporate here with this investment. And one of the first things I want to say is that when you have rental real estate property, rental income is always considered passive income. And so kind of some of the basics, if we think about, let's start with some of the basics. Let's see how that applies to what we're doing here. And then let's talk through some examples and maybe some tax planning. And then if we have time, I don't know that we will, but I do have some slides in there that talk about some proposed legislation that they've been trying to pass to kind of mess up the capital gains rate. So that's a little bit at the end. And so that's the overview of where we're going to go today. So if we start with the basics and how that applies to your investment here, rental real estate is considered passive income. And why that's important is because if you have a loss from that rental property, a passive loss can only be used to offset other forms of passive income. So if you invest in some rental property and it's throwing off some losses, you can't use that loss to offset your W-2 wage income. Or if you have a business that you operate that's a Schedule C, you can't use that rental loss to offset that operating income. It can only offset other forms of passive income such as interest income, dividend income, or capital gains. So I always think you have to think about what is your motivation, what is your goal when you're making these investments. And if your goal is that you want this return on your capital and you want a big return on your capital, then the way that we're doing it here is the way to go, because it's passive income. You're a passive investor. And you invest in these properties, and they're throwing off these passive losses for the first few years. And one of the strategies that we also use is we take advantage of what's called bonus depreciation. Now, many of you, I'm sure you know that when you buy an asset for business, you set it up. It's considered a capital asset. Like if you say you have to put in a new HVAC system, so it's $10,000 for the HVAC. Well, you set it up and you expense a part of that over so many years, 20% a year. But under this bonus depreciation, you have the election to expense 100% of it in year one. So you can say, we had to buy this HVAC, it was $10,000, we're going to expense all of it. And that's going to throw you into a loss for that year. And because it's from rental property, it's a passive loss. And again, it could only offset other forms of passive income. So you may be thinking, well, that's not doing me any good because it's just sitting there and it's carrying forward, and then the next year you have another your rental property generates a $2,000 loss. Well, now cumulatively you have a $12,000 loss that you haven't been able to use. But because you're watching the market and you know that the time is right to sell this property, you now sell the property and you trigger a gain. So now you've got a $20,000 gain. It's a capital gain. You got a $20,000 capital gain. Now you've got this $12,000 of passive losses that you've incurred that you haven't been able to use. That $12,000 then is released, and it can be used to offset that $20,000 capital gain. So now you're only paying tax on $8,000 of the gain, not $20,000. And that is the beauty of the strategy and what we're doing here. So those first few years you're going to see losses and you're not going to be able to use them on your tax return, and you may be concerned, but you shouldn't be, because that is the intent and that is the plan. We want to generate as many losses as we can in those first few years, because when the market is right it's time to sell that property. And I think we heard Brian say tonight there's a few people getting checks, so the market was right. It was time to sell the property, and you should be able to use those passive losses that you've accumulated over the years to offset that capital gain. One thing that you have to be a little on the lookout for is because with this bonus depreciation, when you take bonus depreciation, if you sell the property within a short period of time, and I won't bore you with the number of years and this IRC code, blah blah, nobody cares, but just know that if you sell that property, maybe you're supposed to keep it for 10 years, but you sell it within 3. Well, now you've got to what we call recapture part of that bonus depreciation that you took. And really what that means, it can be a little confusing, but really what they're telling you is that because you sold the property sooner than anticipated and you did not have a chance to, if you weren't taking bonus, you would have depreciated the property, say, over 5 years. So if you sell the property in year 2, you only took 1.5 years depreciation. But because you took bonus, you took all 5 years in year 1. So now you have to recapture that expense that you accelerated. And what they want you to do is just reclassify that into ordinary income. So now instead of a capital gain of 20 million, now you've got a capital gain of 18 million because 2 million they wanted you to recapture as ordinary income. So it just means that part of that you're going to pay your regular tax rate, which depending on your income can be anywhere from 10 to 37%, and the capital gains rate is anywhere from 15 to 20% depending on your income. So this can be a situation where we like, as a tax person, I like tax planning and I like telling people you need to do this to get the best tax outcome, but tax doesn't always drive the equation. It's not the tail that wags the dog. So you can come up with this great tax planning, like we just said, let's do bonus depreciation and let's kick off these losses, but then you sell the property the next year, and now part of that you've had to recapture as ordinary income. But the issue there is that you've got to follow the market. So there are many times there are other factors that indicate the decision on when to sell the property, not just tax. So sometimes that's going to factor into the equation, and tax doesn't always drive what is the right answer. So you may sometimes find yourself with that depreciation recapture, but it's not that the strategy was flawed, it's just that the market changed and you were better off selling that property now than waiting until you didn't have depreciation recapture when the market tanks, and then now instead of a $20 million gain with $2 million of ordinary income, now you're at a $3 million gain. So you would have been better off selling it when the market conditions are right. So as I said, originally, rental income is always passive. There are a few exceptions. So sometimes you may think that you want to invest in a property and you may want it to be a longer term, not just to get in, hold it for a few years, sell it, get your return on the investment. You may want to generate losses that you can use to offset your other business income or your W-2 income. And the way to do that is you have to find a way to get out of this passive income exception. And so there's a couple of ways, and these slides kind of go through that. One is to be a real estate professional. So you see a lot of people in the real estate who are licensed real estate professionals. They do a lot of rent houses and flipping. And it's because they can do that because they're a real estate professional and they meet these requirements where they spend more than 750 hours, what they call materially participating. Some of the benefits of being this, to get your real estate license and to be considered a real estate professional, is that you don't pay the net investment income tax. Now, I noticed here on this slide on that last bullet, there is self-employment tax because my proofreader kind of missed that. There is self-employment tax on rental property if you're a real estate professional because that is your trade or business. So there is self-employment tax always imposed on your business income, but then you don't get the net investment income tax. and we'll talk about that in net investment income tax in a second. But if you're not a real estate professional, you can also get some other exceptions by meeting this criteria of material participation. So I always think about if you are the one that, if you own 10 rental properties, rent houses, and you're the one that arranges for the tenant, you collect the rent, if there's a leaky faucet, you call the plumber. You know, you are managing that property. You're not paying someone else to manage that property. So more likely than not, you are materially participating in that management of that property, and you could meet that exception and not be required to treat that income as passive income. So here's a quick example. You can see how this might be beneficial if you own 3 buildings and you materially participate in C, which means you're managing that property, you're collecting the rent, you're arranging for the repairs. But in A or B, you're just maybe you're just a limited partner and you're not doing anything, or you've got a management company. So C, the one that you are materially participating in, has rental income of $25,000, but then A and B each have losses. So what you would have to do, you have to make this election to treat all of those activities as one activity. And by making that election, then you're considered to be materially participating in all 3 properties, not just the one. So then you get to use those losses generated by properties A and B to offset the income from property C, and then your taxable income is now $15,000 instead of $25,000 with the $10,000 trapped as a passive loss that can only be used against passive income. So this just kind of walks through another criteria of making this election to treat it as one activity. It has to be rental real estate activities. It can't be an activity for construction of the building. It has to be for rental activities, not construction or acquisition. So just a little rule there. The third way to get around this passive activity rule limitation, if that's your personal goal, is another exception, is to be considered actively participating. The standard isn't as higher. You don't have to meet a number of hours of providing service. You do have to significantly manage that property. You've got to own at least 10% of the property, so any less than 10% investment would not apply. But if you can get to this active participation, then you get to deduct up to $25,000 of the losses, of these otherwise passive losses. You can deduct against your ordinary or business income, again, as long as your income is $100,000 or less, your AGI, or $150,000 if you're married filing joint. Yes?
Is that $20,000 fixed, or does it depend on the condition of the property or the specs of the property?
It's a fixed amount, so it wouldn't really matter the condition of the property. If the property is throwing off, a $30,000 loss, and you're considered to be actively participating, then you could take $25,000 of it as a loss against your business income, and then $5,000 would be suspended or only able to use against your capital gains or interest income or dividend income.
Is that per property or
Per
per taxpayer?
taxpayer. Per taxpayer. And so you're in this rule, or you actively participating, then participation as an investor counts. And these are some activities that the IRS says that you can consider to be participating in as an investor. I'm just going to talk about this briefly on this real estate investment tax. It is an additional 3.8% tax on your income from investments. And it applies if your income limits, you have to have, if you're married filing joint, more than $250,000 of income or AGI. $200,000 of AGI if you're single. So again, as we said earlier, if you're a real estate professional, you're not paying the net investment income tax because this is your operating income, but you would be paying self-employment tax. But as an investor, If your income's over the 250 or 200, then you're going to pay the net investment unless you meet these exceptions away outside of this active, be it active or material participation. If you have a short-term rental, like an Airbnb, that's not subject to the net investment tax. Or if you have a rental property that you own and you're leasing that rental property to another business that you operate, like if you've got you own a building and you're leasing it to a retail store, and that retail store is paying you the rent, then that's not subject to the net investment income tax because you're managing that business. Let's see. Here, these are just some additional rules and specifics over whether your income is subject to self-employment tax. It's, like I said, it's generally not subject to self-employment tax unless it's considered your business and it's your active trade or business and a non-investment income, and that's the big difference. I want to go to a couple of these planning ideas. I'm going to just mention this one briefly. This has to do, a lot of people, if you're having your Roth or your IRA, you can create a self-directed IRA, and that self-directed IRA can invest in real estate. Your traditional IRA or your traditional Roth IRA cannot, but you can use this. There's a lot of different rules around how much income you have to make, whether you can contribute or not, so be aware of that. You also have what's called unrelated business income tax issues. So if you have your self-directed IRA, only certain activities are going to be tax exempt, and if you have anything outside and it's considered unrelated business income, then you could have some taxes. We're not going to go into that. That's very specific, and just to be aware of it, it's something to consider. I think it's something that people should know about, and I would talk to your financial planner and to see if this something that would make sense for you. This other, I think this is probably maybe the last example of a planning that I wanted to mention to you. As I said earlier, it kind of depends on what your purpose is for investing, but it also you have to look at, is the property an income producing property, or does it generate losses? So sometimes you can have property that generates income. So let's walk through this example for a minute. You can have rental property and it's held in your partnership, this rental LP, and then you also have a management company that it's going to manage. So say you've got an apartment building, it's held by rental LP, and all it does is own the building, and then it pays a management fee to your management company LP. And the management company LP is the one that pays all the utilities, collects the rents, screens tenants, does repairs. So it's truly managing and operating the company. So the income from your management LP, the operating, that's not passive income. That's not income from rental income. So this management LP can generate ordinary losses that you can use against other forms of income, not limited to just passive income, while your rental property LP, it's going to only kick off rental passive income or losses. So by using this management company, you can funnel some of that income. You kind of recharacterize it from rental income to operating income, and you can take advantage of being able to deduct those losses because they're no longer passive. So let's walk through an example here. So we've got an apartment. It's going to collect $100,000 in rental income, and it's going to pay over to management LP a $95,000 fee to manage the apartment, screen the tenants, do AC repairs, utilities are out, check the plumbing, do the lawn, bug spray. So rental LP is going to have $5,000 in rental income. that rental income is passive. It's, in this case, it's passive income, but it's income, so it's not limited. Management LP, you know, it has the employees, it pays the wages, you know, it pays the insurance, all the operating. It gets this $95,000 of management fee, but its operating expenses are $110,000, so it has a net loss of $15,000. So if you're the investor, you've got coming to you now an business loss of $15,000 that's not limited, that you can deduct and use against your other forms of income, and then you have this rental LP income, you know, of $5,000. So your net is, you've got a $10,000 loss that it's not suspended. So this would be a strategy that would be used if you wanted to hold on to that property for a long term, and you wanted the benefit of those losses current year over year, not where you know in 2 to 3 years or 3 to 5 years you're going to sell that property and you're going to trigger the gain. And so when you know you're going to trigger the gain in a short period of time, you want those losses to build up, so when you sell the building, you can release those passive losses and use it to offset the gain. So as we talked about, if you know, if you didn't have the management LP and you just had the rental, and every year you were generating you know, this $10,000 loss every year, well, over 5 years you've got a $50,000 loss. But if you sell the property now for $75,000, you're only going to pay tax on $25,000. But if you use this example and you have the management LP, you're getting the benefit of that loss every year, so there's nothing accumulating. So when you sell the property, there's no losses to offset that gain, and you're going to pay tax on all the gain. So it's really, in some ways, it's a timing difference, but again, it just comes back to what your particular tax goals are. I don't think we're going to go into that. So I think I'm going to stop there and just see what questions we have. Yes.
Let me real quick, if you don't mind. We've got a lot of people online, so let me get the microphones, and we'll pass them out. So if you have a question, raise your hand. I will bring you a microphone, and then so that everybody online can hear the question as well.
So in that previous example, there's that $5,000 revenue. Are you still paying taxes on that, but you're accruing a $10,000 holdover that you can then use at the time of sale? Is that correct? Or do you have a loss where you're paying no taxes?
Okay, I'm sorry. I'm trying to get my slides back where we were at. So are you talking about this example with
Yeah.
okay, and I'm sorry. Would you repeat? I'll pay attention now.
That's fine. So in that example, are you still paying tax on the $5,000 and you're accruing that $10,000 as, you know, a loss that you can take against the sale in the future, or are you paying no tax because, like, hey, you've got $5,000 income, there's $10,000
yes.
loss, I'm paying no taxes?
You're paying no tax. You're paying no tax. So in this particular situation where you're using the management company to create operating losses against the rental income, you net the two. Your net loss is an operating loss, so it's not passive, and so it's not limited. So you use it that year, and so you've used that $10,000. You know, maybe you have you know, $150,000 of salary, of W-2 salary, or retirement income. So you can use that $10,000 to offset your retirement income or your wages, and you've reduced your tax burden in that current year. So there's not a $10,000 loss available to accumulate to carry forward. So it's a different intent, a different motivation on why you would invest.
You got a microphone? Oh, I'm sorry. Right there.
Going back to the K1s, when you have multiple properties, multiple K1s with bonus depreciation for each one, that's going to be adding up to your losses?
Well, so the bonus depreciation would be part of your losses, yes. It may be stated separately on your K1, but it is part of that. You know, I think it's line 2 on your K1, rental, net income or loss from rental, whatever that, if it's a $5,000 loss, that bonus depreciation is already inside that number. Sometimes they want you to separately state, especially, so we didn't talk about this, you can do bonus depreciation, or It's basically, it's the same effect. It's just called Section 179. So it's, again, if you purchase an asset for $50,000, you can expense the full amount of that $50,000 in year one, as long as you have taxable income. So Section 179 is a little different than bonus because you can't fully deduct the asset unless you have overall income. But it can, you will see that separately stated on your K-1 sometimes.
Okay, it'll be separately stated on the K-1, but with multiple properties, you're essentially, I guess, accumulating the losses for your passive income as a whole, I guess.
Right.
Right. Okay.
Right, right. And they will track on your return, year over year, and then in year 3, when you sell the property and have the gain, then you've got these losses that have accumulated for 3 years, and they're available then to be released and to offset against that capital gain.
Okay, and just one more. And the best way to estimate, is there like a certain way to estimate your taxes based on your K-1s, or just look at your losses?
I would look at that losses. If you're just looking at the K-1, you're gonna need to track it year over year, because the K-1s, there's not a mechanism for it to carry forward. Usually where we see it, if we're preparing the return, if you're using the same tax software, that your tax software will accumulate that for you. But your best bet, if you're just wanting to look at it, you'll just have to go look at those K-1s and maybe just run a spreadsheet, just start a little schedule on the side. Year 1, this was my loss. Year 2, my loss. And then you'll kind of have that total in your head.
Question was on a bonus depreciation. So if you purchase a property for $100K, use bonus depreciation, you can write off $50K. So then your tax basis is now $50K. You sell the property for $150K, so the gain is going to be $100K, right?
Right.
So
right.
The bonus depreciation, even though it helps you in year 1, it doesn't really help. Like when you're selling it, you're still going to pay the same regardless, right?
Well, so if you fully depreciate, depreciation, all it is, whether you accelerate it and take it in year 1 or whether you take a % over a 10-year life, depreciation always reduces that basis. So when you reduce your basis, your gain goes up. So if you buy something for $100,000, in year 1 you expense 10, now your basis is 90,000. In year 2, another 10, now your basis is 80,000. So now if you sell for 100, you've got a 20,000 gain. But you got the benefit of that expense in the 2 prior years. And so bonus is the same if you buy it for 100, but if you say I want to bonus all of it in year 1, now your basis is 0 in year 2, but in year 1 you had a $100,000 loss because you expensed the full amount of that asset. Again, if it's passive, it's going to sit there on your schedule, and then in year 3 you sell the property, you have no basis, you fully depreciated it. Your basis now is, say it's 200 because the market went up. So now you've got a $200,000 sale, your basis is 0, you got a $200,000 gain, but you've got a $100,000 loss over here that's been waiting for this gain to match up with the gain. So now it matches. And so now you're only paying tax on what that increase in market value was.
So for that investor, the only benefit was the timing, because you're still going to pay tax on the same amount with the sale for a passive investor.
Well, that's true if depreciation were the only expense, but that's not. There's plenty of other expenses, so you are going to see the benefit.
Right up here. Hey, it works. I've got a W-2 job. My wife has a W-2 job. My wife gets laid off. She's on unemployment for a while and not drawing any money for part of the time too. She gets rehired during the year. I've got 16, 20, something like that, K-1s coming in at the end of the year. I've got a single-family rental that generates a small loss. Throughout all this, I have no idea how to do any tax planning from year to year. I've just finished my 1040 for last year, filed an extension, going to mail it off next Monday because I don't want to send it in any sooner than I have to. And right now it shows an effective tax rate from last year of 8 point something %, which is pretty darn good. If I had known
at any point last year that I was going to have a tax rate of 8%, I would have done some other stuff, like primarily Roth conversions. Do you have any suggestions as to how to be able to figure it out? Because I've got, when I said the 20K ones, I've got, over the course of the year, 2 or 3 properties being sold, generating capital gains. I've got 3 or 4 properties I invest in that generate losses plus bonus depreciation. So how do you have any advice as to how to try to figure out and do some appropriate tax planning in such a situation?
So,
I thought the answer might
call
be
me. Call me. No, you can try to, this is what I would do if I were estimating that for you. I would be looking at what those prior year K1s were, because typically we're basing it on what the prior year activity, and if they tell you, hey, we've sold this property, so you just have to basically estimate to the best of your ability what that activity looks like when they tell you that they've sold a property and what they gain. And then for your others, you just kind of have to use the same as last year. Now you had change in circumstance, so you have to modify that, but you're basically kind of doing an estimated return to understand what your tax situation is for that year, to know what your effective rate is. And I do tell people, when you get into October, it's a good time to look and evaluate and see where you are for the year, because when it's not always life change, life happens, and so you do need to have a better understanding. Do I need to pay in? Is my rate up, down? Somebody else had a question. Yes.
I have a question about, just piggyback on what he was saying. For Roth conversion, that income cannot be offset by the passive loss. Is that correct? It's a taxable income now, Roth conversion.
That's right.
is.
Well, when your Roth conversion, if it shows up as a passive income, like a capital gain.
Roth conversion becomes a taxable event.
Right.
When it becomes taxable event, that cannot be offset by just the passive loss only.
Well, I think it depends on what you're converting. If it's wages, then you're right, you can't.
I'm talking about traditional to Roth. From traditional IRA to Roth conversion, $100,000 would not be offset by $100,000 passive loss.
Right.
Is that correct?
Right.
Okay.
Right.
So even if he finds out he's at 8% tax bracket, that passive loss would not help him offset the conversion.
It wouldn't help you, but you know that particular year you're in an 8% bracket, as opposed to the next year you're going to be in a 16% bracket. So you want to do that Roth conversion when you're at your lowest. And I think that's what the point there.
Point was. Okay.
Yeah.
And one more question I have. A lot of people invest in real estate in the syndication deal, which is a leverage investment from their Roth or traditional IRA. How does the UDFI comes into it? Is it okay to invest from IRAs into real estate, or it should be only cash investment?
So you're going to need to talk to your financial planner, because a traditional IRA is not able to invest in real estate. You have to create a self-directed IRA, and that is the only way that you're going to be able to invest in any other type of activity such as real estate through your IRA.
Okay, I think UDFI I was talking about, let's say I have a 20% down payment and 80% is a leverage for that particular deal in investment from IRA. Then if I get a $1,000 distribution, then $200 would be non-taxable, because that's my investment 20%. $800 I have to pay UDFI from IRS standpoint. Is that correct?
I think so, if I understand what you're saying.
Okay.
UDFI.
Okay. Anyway, thank you.
Okay.
What happens to the basis of your property when you pass away and leave your assets to there?
Okay, so the question is, what happens to the basis of your property, when you pass away and your estate is transferred to your heirs? So if it's real estate, the current market value of the property becomes the heir's basis in the property. And so if they sell shortly thereafter, typically there's no gain or loss recognition, because their basis becomes the fair market value basis. And you also have up to $11.5 million of your estate that you can transfer tax-free over your lifetime.
I've got a question on the UBIT. How often are you seeing people exposed to UBIT?
You know, that's not really something I've seen very much of.
Can you say that one more time?
The unrelated business?
No. How often are you seeing?
Not very much. Not
Well,
very
and
often.
The reason I ask is a lot of our investors, a lot of investors that I know that invest passively through self-directed are always hearing the horror story about UBIT. You're going to be exposed to UBIT. And yes, the possibility exists, but how often do you see that?
I haven't seen it on any of my clients. I haven't seen it. But it is, you know, I think it's one of those where as a CPA, you're risk averse. So when you always want to make sure that you're over communicating to minimize risk. And so that's why we always have to point out this unrelated business income tax and be aware of it and be careful of it. And I always would say, please talk to your financial planner. I'm not a financial planner, I'm a CPA, I'm not a CFP. And so whenever it gets too in-depth in the retirement, I always encourage you to talk to your retirement planning person.
Donna, just in general, kind of the questions that are coming forth from people online, is there one or two bullet points you can tell us about what maybe you think might be coming next year that might help people plan?
You know, I will move to these. I did have some slides in here. So, you know, the big thing, the hot topic has been, what are they going to do with the capital gains rate? Are they going to increase it? And there is some legislation that is proposed. It was not part of this Inflation Reduction Act that was recently passed, but they have been trying to get the capital gains rate passed, and they want to impose capital gains on unrealized gains. So as your value in property appreciates, even though you haven't sold it, then you would have to pay tax on this unrealized appreciation in value. I just don't, and here, your question about the step up in basis, that's another proposed rule. They don't want they're proposing that the inherited property not get the step up in basis. You know, the tax is so politically driven. You know, my husband's a CPA, but he's always the financial planning and analysis, and he will try to talk tax with me occasionally, and he's very rational, and he's like, tax doesn't make any sense to him, it's not rational. And I'm like, no, there's nothing about tax that's rational, it's political. Tax laws are passed because lobbying groups work. So you can't apply logic or reason or ration to tax law. So you have to look at the political landscape. And you know what we see, it's chaos. You know, in my view of what I see, I for the longest time, for many years, was tied very closely to the state of Texas and what was going on with Texas legislation. And so as part of that, you start monitoring what's going on in DC as well. I mean, what if they were to make any of these changes to the capital gains? I mean, they could. If I think that they would do anything, it would be just to raise the capital gains rate. I don't see how they can pass it on this unrealized gains. You know, you have to actually sell the property. It's not even good accounting. You know, our accounting principles don't even let us recognize gain that you haven't realized. Right. You know, you haven't realized it. It's if you haven't sold it. Just because you hold an asset and it goes up in value, you don't have that cash. You know, you just have an intangible, and so that's not. You don't recognize that income for accounting purposes, and so it's crazy to me that they would think that they could tax you on something that you have not realized or recognized. So I don't know that I see that happening. A lot of what I think, you know, we've got the elections, the midterms coming up. You know, probably, most likely, the Republicans take over control, and you know, then we're in a stalemate and nothing happens, and then it's time for the next election cycle, and so probably nothing will happen for the next couple of years.
Hey,
That's just kind of my thought.
Sorry to interrupt, but we have a question online. The question is, if you have bonus depreciation, then recently sell the property and have a large gain, could you pay more in taxes if your ordinary income tax rate is higher than the passive tax rate?
Yes, yes, absolutely. And that's what we were talking about early on. If you did take, you say you bought the property in 20, you'd 100% bonused it out, $2 million, 100% bonus, took the $2 million, then 2 years later you sell it, for $3 million. Well, say 500,000 of that you have to recapture as ordinary income. So now 500,000 of that bonus depreciation you've had to recapture and it's ordinary, and then the difference is capital gain. So yes, that is true. And if you're in a tax rate, effective tax rate is higher than 20%, then yes, you would pay more on that piece, that 500,000, that piece that's bonus depreciation recapture. And one thing I wanted to mention on the bonus, 22 is the last year that we're going to get 100% of bonus depreciation, because it starts being phased out in 23. So in 23 you'll only get 80% of the property that you'll be able to deduct in year one, and then the following year I think it goes to 60%. So they start phasing it out. So we really want to take advantage of that bonus depreciation. So you've got 2.5 months before December 31st if you want to buy something, some capital investment for your business and bonus depreciate it to get that tax advantage. Now's the time to do that.
Thank you, Donna. Thank you.
Oh, we have one more.
Oh, sorry. Go ahead, John. One more.
Let's
Let me get your microphone, please.
okay, hypothetical situation.
Here you go, hypothetical situation. Let's say you have a lot of income in a specific year and you pay a lot of tax, and then the following year your income is lower and you have lots of depreciation, right? Can you apply the depreciation to previous tax years and say like, well, hey, I paid a ton of tax last year. Let me apply some of these to the tax I paid in the past. I'll lose them, I'll forfeit them, but let me get a refund because
That's some pretty creative tax planning there. So
that's why I'm asking.
No, I don't. No, you can't. I mean, you could go back and amend your return and change your, but you can't if you bought it, in 2020, but you didn't bonus it, and then you get to 22, and you're like, oh dang, I should have bonused. Well, then you can go back and amend, but you can't then catch up, in 22. I mean, I guess you could if you get audited. It's just kind of a timing difference, but there'd probably be some penalties that while they're washing that through the 2 years.
let me just say here at DGRE, we're always going to ask Donna to follow the law. And
Absolutely, we're only following the law.
Donna, thank you very much. Ben, I just because this seemed to be a hot topic tonight, I do want to give you one quick example of what Donna's talking about tonight. Ben's property, the Brazos. Now, when we bought that property, we fully intended to hold it just like we do all other properties, 3, 5, 6, who knows how many years, right, Ben? That was the plan. We took bonus depreciation, accelerated depreciation. However, we sold that property in less than 24 months. So that's what she's talking about. Some of that gain is going to be reclassed or recaptured as ordinary income. So this is a real world example of that. However, I will reiterate what Donna said. That doesn't mean it was a bad decision to take bonus depreciation in first year. It's just the market changed on us, and we realized that at this time it was with Ben, consulting on it, there was the time to sell it. So fully aware of that, but that's a real live example of what happens in that situation. Again, Donna, thank you very much for coming tonight. We thank you for being here. And I'll get some business cards maybe from Donna. If anybody wants a business card, I'll be glad to pass them out. Julian, if you would come up. And
So good stuff, right, guys? Donna, thank you so much. I've got a question that might embarrass a few of you. Who here is not using a CPA? Come on, Dillard. Okay. Do you do your own root canal and that kind of stuff? Why in the world, in today's complex environment, would you not use a CPA? Dillard's a smart man. I will grant him that, and he probably is able to do his. But trust me, guys, I hear, as the investor relations director, I hear every year, over and over, from our investors who do not use a CPA, who don't understand how their K1 was put together, what to put into their returns, and it's a nightmare for them. So, no dog in the hunt, just letting you know that you should have a CPA on your team. What do we always say? Real estate is a team sport. Have a CPA on your team. Okay, wanted to discuss very briefly our Frankfurt Station partner loan. It's gone very well, been very well received. We have a few more spots available, and so if you want to participate, it's a awesome 10% cash on cash opportunity. However, I do need the funds by the end of this week, maybe Monday of this coming week at latest. We are going to be closing the refi next week, so I have to have the funds in the bank. So if you're wanting to take advantage of a 10% cash on cash while inflation is running at 8%, if you believe the talking heads on TV, take advantage of that. If you want to take your CD and money market at 2.5 at best, then have at it. So it's a great opportunity. We're preserving a great captured equity on this property. The value is in the property. The problem that just about everyone right now is facing is that the banks are not loaning enough on the whether it's new acquisition loans or whether it's refi, where even a short 8-10 months ago we were able to get as high as 82% on properties. Today you're doing well if you get 60%. Average is probably more like 55%. So that's where the problem is coming in. It's not because values are not in the property. So if you are already committed, which a great many of you have, I need your funds in. If you're not or haven't given it serious consideration, I would urge you to look at it, give Garrett or myself a call. We'll be happy to discuss it with you. All right? Otherwise, let's see, what's coming next? You've got your clicker. But I did want to say, you know what I enjoy about these is to see people that I've known for years. Steve, I remember, stand up, Steve, just because people don't know. I've known Steve, gosh, 10 years, 12 years? I remember when Steve was trying to get into the multifamily, and he was wringing his hands because he was going, yeah, I know this is the place to be. I want to get into it, and I don't think he'll have any problem saying this, because if it was yesterday, he probably would. At the time, he didn't have the money to get into an average multifamily deal that required 25, 50, right, 100,000. And now, fast forward, I need to burn my money to have the kind of money he has. So thank you for the confidence that you've placed in us, Steve. I greatly appreciate it. He's a good man. And the same thing with a lot of you in the room. So thank you so much for being a part of DGRE. And without you, I always say, nothing that we do would be possible. So thank you. Up to you, my friend.
Thank you. See, I get to save the best for the last, but, we really do appreciate Donna being here tonight. I know she was a little bit under the weather, but appreciate her toughing it out and answering your questions. Anand, would you join me on stage, please? Please. Come on, big round of applause. Would you grab that first check, if you would? You don't have to unfold it yet. I would like anybody that's in the audience that is a partner in Southwest to come up on stage, please. Come on. Don't be shy. He needs help holding up this check. And I'm going to jump in the back here. So. Yeah, that's true. Jeff, you got to be in the back. All right, now let's unveil it. Okay, and I'm going to move. We'll be able to see this when everybody moves. If everybody will just look at that middle camera that's on the ceiling, please, and it'll take our picture. Mo, whenever you're ready, and you tell us when you're done. All right, good. Okay, let's look at this. Do me a favor, Jeff, kind of move to the side a little bit. If you see on the slide, congratulations to Southwest Partners. $3,337,115 distributed to partners at closing. There you go. Total return on investment, 71%. Anybody signing up for that? No? Okay, I need to hear. Anybody signing up for that? Okay. For an average of just under 25% annual rate of return. So, Anand, again, thank you for shepherding that process all the way through. And sorry, this check is not actually a good check. For those of you who may follow Facebook, you might see my grandson tried to take one of these checks to the bank. I actually wrote him a check after his first job. He picked up trash at a property for me. Yes, we're all out there working. And he had the pleasure, and the bank said, tell him to bring it in. We'll cash it. So it was awesome. Okay, Ben, would you come forward? I'm going to ask you to do the same thing, please. Are there any Brazos partners in the house? Look at Bob. Jeff, look at it. These people just raking in. Come on, man. Come on up if you will. I'm sorry, I should have said stay up here. Oop, I went backwards. I don't know how I did that. Bob said he had to buy a bigger money bin because of what DGR was doing to him. Having said that, Ben, congratulations. Brazos partners, you have not gotten this money. Unlike Anand's money, which most of it has already been distributed, you still got one coming. This will go out end of this week, maybe into Monday next week, but you'll see it again. It's only been 1 week today we sold that property, so a little over $7 million. Congratulations, Ben. And again, if you guys would kind of, I'm sorry. Let's take a picture first. Please get in here. Bob, help him take a picture, please. Mo, you tell me when they're ready. We're good. All right, thank you. All right, Ben, if you'll set that against the wall. And again, is anybody going to sign up for a total return on investment of 70%? Okay, I thought they learned after the first one. Is anybody going to sign up for total return on investment of 70%? The only difference in this one a little bit, again, annual rate of return, 42%, is because how long did we hold that property, Ben? A little over 18 months, almost 19 months. So obviously that's accelerated annual rate of return. So again, congratulations, Ben. Congratulations, Honor. Congratulations, Reggie. All good. And that's about, correct me if I'm wrong, but I believe that's about $54 million that we will have returned that DGRE this year in 2022 has returned to his partners.
And if you want better returns than that, then go to B of A, Wells Fargo.
Yeah, you can ask Anand about B of A. He's not a huge fan. I'm not either, but anyway. Okay, time for I know we've kept you quite a bit. Questions about anything and everything before we cut you loose. And Garrett or Mo, if you'll tell me if there's anything online too. Anything and everything. Bob.
We have 5 deals in contract right now that we're going to be, no. We, so that's a question that I get, Garrett gets almost on a daily basis. We want you to understand is we are looking, we're always looking. However, the biggest challenge right now, as I said earlier, is loan dollars, okay? So it is very difficult to analyze a property when you don't know from the time you put it in the contract to the time you close how many dollars they're willing to give you on a loan. So they might give you a debt quote of, let's just throw out a number, $23 million to that property. And then 2 months into escrow and you're about to close, they say, yeah, sorry, that $23 million, it is now $19 million. Right? And they have no problem telling you that within a week, 2 weeks of closing. So until that settles down, we're very, very cautious about getting into something until we feel like it is an absolute slam dunk. And we will not, you guys are old enough. You remember that old, Parmesan wine? We will sell no wine before it's time, right? Some of you guys remember that. We will not roll out a property unless we feel very confident in it. We can roll out property. We could put property in the contract, and it would be a disaster. And I can tell you right now, I am seeing more and more disasters taking place. And there's some other organizations out there. We won't mention any names. However, we have our own challenges, and Frankfurt Station is one of them. We're overcoming it, but the problems are there, and they are real, and that's why we are somewhat reluctant to get into this market right now. So, Bob, it's a long-winded answer to a very short question.
Any other questions? I'll bring you a mic, I promise. About anything. You got nothing?
Who's better looking?
Well, I've got the mic, so I'm going to say it to me anyway. So.
Well, if no other questions, then let's call it a night.
Yeah, I do again. Appreciate you coming tonight. We appreciate all of you that are online. We hope you found some value in it. We will have a November meeting. However, we will not have a December meeting, okay? So we'll plan it for November, second Tuesday of the month. And we'll certainly send you a reminder. But again, thanks for coming. Congratulations to all of you who are sharing in that $54 million that's been distributed this year. Don't spend it all in one place. And again, congratulations. Shake the hands of our co-sponsors tonight on their success of their 3 properties. And if you're new, please let me get a chance to meet you before you leave. Thanks, everyone.